today we're focused on understanding credit risk. This is going to feel a little bit like you're a credit manager going into your first ever lecture. We'll call it Credit Risk 101. Anyone want to sign off now? Maybe, maybe not. I've got what I believe is some great content for you. Some of it gets a little deep, but bear with me and I'll try and bring it together and summarize the information as we go. Gotta love a good disclosure statement. If you want to read that in full, I'll let you go back and see that in the webinar notes and in the recording. So feel free to read that in the future and I won't bore you with it too much right now. Okay, so our agenda today, I'm going to split the information into two parts. So first of all is understanding credit risk for mortgages, residential mortgages that is. And then secondly, how Squirrel manages that investment risk or that credit risk for you, which is your primary risk when you're investing with us. All right, kicking into gear, the investment risk spectrum. I suspect this is somewhat familiar for many of you. So at the lower risk end, generally speaking, or lower risk and lower volatility end, you have debt type investments, which is what Squirrel offers. Walk up the ladder, you get next to property. So it could be residential, commercial, or industrial, where you own the property in some way, shape, or form. Keep going up that ladder, you get to equities. So it could be local share market, international shares, could be active, could be passive. And then you get to exotics. So what you tend to find is, generally speaking, lower risk and lower volatility at the left hand end of that spectrum, and a bit more risk and volatility at the right end of the spectrum. Just because debt, I've said, tends to be lower risk and lower volatility, not all risk is the same, or not all debt is the same. So if we walk through three of the most common ones, you've got government bonds. You could invest in the USA government bonds, or you could invest in Somalian government bonds. You can probably figure out which one's the lower risk of those two. Equally, if we look locally at bank deposits, you've got ANZ Bank, who have a AA- credit rating, and you've got SBS Bank, who've got a BBB rating. So quite a big difference in credit ratings across banks in New Zealand. In the bottom category, I've called it fixed interest, and it's a pretty wide-ranging group. You've got residential mortgages, which tend to be at the lower risk end of that spectrum. And then you've got things like Hanover Finance debentures. For those of you who lived through the GFC, you'll probably realize that Hanover Finance doesn't exist anymore. Their debentures were pretty high risk and they fell over and people lost a lot of money through that one. So everything's a spectrum when you're investing in debt, different types of debt, some of which will be lower risk and some of which will be higher risk. So you can actually quantify credit risk. All right, so for the boffins amongst you, here's how you would actually quantify it. So first of all, take what's the chances of a loss occurring. Okay, so you think of a portfolio of loans. How often might one default? That's what you're asking there. The second part of the equation, so loss given default. So if a loss does occur, how much are you likely to lose? Make sense? Multiply those two things together and that will give you your credit risk. We'll do a worked example in a moment. So what is credit risk? It's the chance a loan's going to go bad. If it does, how much might you lose? When you're investing in debt, then credit risk is the primary risk you typically face. There are other types of risks as well, and I'll cover those right at the end of the presentation. That formula gives you an estimated credit loss for a portfolio, and you can apply that formula to most types of debt. Most lenders will have a credit model that they're using to try and determine the amount of credit risk that they're taking in their portfolios and determine how much they need to reserve or provision in amongst what they do. So that gives you an idea of what this A, what the formula is, and then B, what it does. Okay, so we're going to now move into a worked example of how this kind of plays out in real life. All right, starting at the top. So let's take a single mortgage. Let's assume that you bought a house in Wellington for $1 million in October 2021. So at the peak of the property cycle, it was an interest-only loan for $800,000, which gives you a loan-to-value ratio of 80%. So that's the value of the loan divided back by the house value. Roll on 3 years to October 2024, and that loan has now defaulted. Okay, so they've stopped making their loan payments, and as the lender, you've moved to a mortgagee sale for the property. House prices have fallen 22.5%. This is trying to be a realistic example. House value is now $775,000, and that's what you get at mortgagee sale. So we know the loan value is $800,000, so you're already underwater at that point. You've also got some mortgagee sales costs. So you're going to have legal fees, probably some advertising fees, and maybe you needed to cut the grass and tidy up the gardens before you presented the house for sale. So let's assume that's $40,000 there, which gives you a $65,000 loss when you sell that property. That works out at a loss ratio, so that's the size of the loss divided back by the loan value of 8.1%. Okay, so that's a single mortgage example. Let's try and apply our formula to that now, which is the bottom half of this page. So you've got a portfolio of mortgages. We said figure out what the probability of loss is. So I'm going to use 0.02% here for this, which is 2 loans out of 10,000 that you will have a loss on. Makes sense? So that sounds like a really low number. Further on in the presentation, you'll see that actually that's not too bad an estimate based on the New Zealand and Australian markets looking back in time. The loss given default we worked out above the line was 8.1%. So we're going to multiply our 0.02% by 8.10%, which gets us to a credit risk of 0.16% on a portfolio of loans. So what does that translate to from a revenue outcome for the lender or the investor? So let's say the interest received from the borrower was 6%. The expected loss is 0.16% per annum, which means your net interest received is 5.84%. Okay, so we've experienced a couple of losses in this portfolio, let's say. You are going to lose a bit of your interest, but you haven't eaten into your principal. Okay, so you haven't eaten into the capital that you've outlaid. You've eaten some interest, but no capital loss, which is a good outcome. Okay, so let's have a look now at what write-off rates have occurred in the residential mortgage space in different parts of the world. Let's look at some severe recessions. So Australia, 2009 through 2012. So that's GFC period, right? You can't even see the line. There is a line there, but very hard to distinguish on the screen. And I'll show you that in a bit more detail on the next slide. UK, 2008 through 2012, so GFC period, there's about a 0.5% loss rate, 0.5% during that period. For Sweden, early 90s, for those of you who were kicking around in the early 90s, you'll know there was a pretty severe recession in many advanced economies at that point. So Sweden, they had losses of about 1.6, 1.7%. UK, early 90s as well, so that was pretty bad. That got almost to 3%. And then you've got Ireland, post-GFC, and I'll cover this in a case study in a little bit. They got to over 5% losses over that 3-year period, 2011 through 2013. I've also got the US in here through that GFC period. They suffered losses of around 7%, which is pretty high, in fact, extraordinarily high. I've painted the US in a different color. The reason being that the US market operates differently than the way the New Zealand and the other markets operate. In the US, you can literally just hand your keys back to the bank and say, there you go, that's your problem now, not my problem. You've effectively given the loan back to the bank at that point. The last point that I've got on this page is around tail risk. So tail risk is what happens when there's a severe disruption to the market or a severe recession. And you'll hear the Reserve Bank of New Zealand in their financial stability updates. If any of you ever want to tune into one of those, they happen twice a year. They talk about stress testing of banks. And what they're really trying to understand is what happens when things go really pear-shaped. So, for example, they'll stress test the banks at a 40% reduction in house prices, just as an example. So you can really get a sense of tail risk when you see house prices fall a long way, and there's a lot of modeling done to try and understand that by banks, and particularly reserve banks, because they want to understand what the systemic risks are of a lender falling over. Okay, hopefully not bamboozling you as we go. All right, promised an Ireland case study. So during that GFC period, they had a 10% loss rate, so probability of loss 10%. And when a loss occurred, it was eating 30% of the value of the loan. Okay, so that's a pretty severe scenario. So in order to plan for that, you needed a credit risk in that tail risk situation of 3%. Okay, so that's what you had to kind of plan for as a lender. Did they? No, unfortunately, they didn't. So what else was going on during in Ireland during that period? So house prices, particularly in Dublin, had increased dramatically in the year or two prior to the GFC taking place. So they're up around 50%. About half of the new lending that was completed in that year or two pre-GFC was over 80% LVR. Okay, so that's pretty high risk lending. If you compare that to what happened in New Zealand during that period, there was less than 10% of new loans were done at over 80% LVR. In fact, there are examples in Ireland of loans being completed at 105% LVR. So what does that mean? That means the value of the property was estimated to be $1 million, and the bank lent them $1,050,000. Okay, so they lent them more than the value of the house, often to clean up some debt or consumer type debt and those sorts of things. So there's some very high risk LVR lending completed. Then we saw a 50% reduction in house prices and an unemployment rate that went to 14.5%. Okay, so a highly severe recession with some lending that you might consider pretty high risk on a loan to value ratio basis. And on top of that, Ireland had been building a heap of new houses. So they had a whole lot of stock on the market, not unlike what we have in the market here in New Zealand right now, where there's lots of housing supply or lots of new houses on the market waiting to be sold. But closer to home now, so what happened in Australia during the GFC? So if we start with the graph on the left, you can see mortgages right down at the bottom. So the maximum 1 year write-off that we saw on mortgages was 0.03% in 2010. The average write-off per annum was 0.02%, 2009 through 2015. On the graph, I've also shown personal loans and credit cards just to create perspective. So you can see those types of loans have much higher write-off rates, and often why they have higher interest rates for you as a borrower, if that makes sense. Right. Finally, let's get to New Zealand. So what do we know about the New Zealand residential market? So here's data from the Reserve Bank of New Zealand. It goes back to 2015. Unfortunately, it doesn't go back through the GFC period. I think we'd all say it would be lovely if I could take the series all the way back to, let's say, 2006 and follow through what happened during the GFC. Unfortunately, it doesn't. So this is what we've got, 9 years of history. So the mortgage market today is $360 billion. Okay, it's a pretty big lump, would be fair to say, given the size of our economy and in relative terms to what we see overseas. The banks are generating revenue. So in 2024 calendar year, using a 1.5% net interest margin of $5.4 billion in revenue. Okay, so that's not profit, it's their net interest margin of $5.4 billion in the year 2024. If we move to the graph on the right, this shows their net write-offs by year. Okay, so 2015, you can see there was $57 million written off. So this is kind of tail end of GFC. 2016, that dropped to 31 million. You can see the graph. And 2024, which, we've been in recession for almost 2 years, you saw the banks wrote off about $15 million. So that was their loan losses on home loans during that period. Remember, they made 5.4 million on their home loan portfolios in net interest income, and they suffered write-offs of 15 million last year. So that's a pretty good equation. I think any financier would be pretty happy with that as an outcome. So what does that translate to in percentage terms? So peak write-off rate, 0.028%. So that's, let's say 3 loans in every 10,000 where there was a write-off. Pretty low. The average rate over that 9-year period is 0.007%. I had to go to 3 decimal places to make that one make sense. So broadly speaking, you would say, based on 9 years of history, New Zealand mortgage market has been a pretty safe place to be for the financiers. Reserve Bank has encouraged that through the use of loan to value ratio metrics with the banks. They can't write lots of loans over 80%. You'd have to say that's a good thing once you look back at that Ireland example. They've also more recently introduced debt to income ratios, which will mean that borrowers can't overextend themselves quite so easily. The other thing that they've done is they've also demanded that banks hold more capital. And if you pay attention to kind of business type headlines, you may well have seen commentary on that in the market where the banks are kicking up a bit of a stink about having to hold up to 16% of capital against their loan books. Really what we're seeing here is the Reserve Bank recognising that New Zealand residential mortgages are a very large lump and could cause systemic risk to our economy. So they're saying, banks, actually, we want you to be really quite safe and quite conservative in the lending that you make. Right, into section 1. Hopefully you've stayed with me and haven't fallen asleep at that point. Summary so far. So the number of loans that default is probably lower than what you might expect. I do wonder if I wandered down the street and said, out of a portfolio of loans, what percentage might default at any given time? Most people, particularly for residential mortgages, most people would probably say, actually, the number's higher than what the data actually tells us. The loan to value ratio that you lend at is really important to understand what type of losses and the size of losses that could eventuate when a loan defaults. Talked a bit about tail risk, really important, and that's something that all lenders worry about quite a lot. So what's the kind of some worst case scenarios that might happen, and how do you plan for that? We talked about the Reserve Bank. They're pretty tough in the way that they regulate banks in New Zealand, and they're trying to prevent tail risks occurring. Last but not least, the actual credit loss rate that's been experienced by New Zealand banks is actually quite low. If you look over the last 9 years, and you could say, well, over that period, actually, New Zealand economy's done pretty well, apart from the last couple of years. But what we haven't seen is large losses materialize from the banks. Okay. There's your summary. So let's start talking about then how Squirrel manages risk for you, our investors. To begin with, there are 3 layers of risk protection that we put in place. So first of all, before we lend money, we will assess the borrower and the project that they have underway and the reason for us to lend to them. So just like a bank does, we get the information from the borrower. We run credit checks, we make sure they can afford it, we do all those sorts of things to make sure that they're a worthy borrower. Second thing that we do is we'll take security. So in the case of our home loans and construction loan, term investments, and for our Squirrel Monthly Income Fund, all of the underlying loans will have a first mortgage in place. And we will lend an LVR, loan to value ratio, that's appropriate to the situation. So a higher risk loan, we might want to see a lower loan to value ratio, for example. On a lower risk loan, we might be prepared to go to a higher loan to value ratio. And remember that the maximum LVR that Squirrel will lend to for our first mortgage-backed lending is 80%, 80. Our portfolios on average run at around 60%. So there tends to be quite a bit of borrower equity in there before the portfolio would suffer a loss on average. Third layer is Squirrel's reserve fund. So this is really what I would consider to be the shock absorber. So let's now talk a bit more about how the reserve funds work. So here's a working example. I've just made the numbers up, but they'll give you a sense of it. So the borrower is paying 8%, investors earn 6%, the reserve funds earn 0.3%, and Squirrel earns 1.7%. So if you think about that, over the course of the year, the borrower has paid 8% interest. Investors have earned their 6%. Reserve funds had money flowing into it each month when the borrower makes a payment. And Squirrel has earned a margin for us to manage the loans, manage the borrowers, and do all the things that we need to do to look after both you, the investor, and the borrower. When a loss eventuates, you see money move from the green acorn back to our investors. So the reserve funds are there to back our investors if any particular loan ends up with a loss. So the role of the reserve funds in a little bit more detail. If a borrower misses a payment, the reserve fund steps in and will make that payment to investors. When the borrower catches up on that payment, they owe that money back to the reserve fund, which helps recapitalize it at that point. If a loan happens to default, so let's say it's a first mortgage-backed loan, the borrower defaults, Squirrel will then initiate the procedure to go through mortgagee sale, as an example. While that's happening, investors continue to receive their interest paid for by the reserve fund. And then once the property is sold, we'll get the proceeds to hopefully cover the loan. If there is a loss at that point, then that money is returned to investors on a net basis, on a gross basis back to investors. So investors won't have lost any money, assuming the reserve fund is capable of making that payment back to them. All right. The reserve funds act as your diversification mechanism. So you get the benefit of the whole portfolio of loans, even though you may have invested in just one loan. In the case of investing in our term investments, the reserve funds help create that diversification mechanism for you. Okay, so you don't need to try and invest across lots of loans. Actually, it's the reserve fund that creates that diversification for you. You get the benefit of the whole portfolio of loans. The reserve fund money is not Squirrel's money. The money is held on trust for our active investors. And occasionally I get the question, well, what happens if you wind everything up? What happens to that reserve fund money? And the answer is, in the case where everything winds up, so let's say Squirrel winds up, stops lending, once all of the loans are repaid, if there's money left in those reserve funds, it goes to charity. And in fact, we've named a charity being the Starship Foundation. So that's where that money goes, should we wind everything up once all the loans are repaid. Squirrel doesn't guarantee the reserve funds. However, no investor's ever lost a cent investing with Squirrel, and partly because the reserve funds have done their job and the credit models that we're running are working for our investors. And I'll cover that in a little more detail as we go. Here's an example of the information you can find on our website about how the reserve funds are performing. So I've used our construction loans as an example. And as I said, all of this information is on our website. If you go to the Save and Invest menu and look at the View Performance page and scroll through that page, you'll see a wealth of information. We're really transparent in the way that this works. And I would say we're one of New Zealand's most transparent lenders, if not the most transparent around how this works. I've rounded these numbers. They were taken off our website yesterday, but I've rounded them just so you get a sense of it. So the active construction loan book is 178 million. So that's the balance of all the loans held in that particular pool of loans. The reserve fund is 3.1 million. Okay, so there's 3.1 million sitting in a bank account, ready to be deployed should losses come through in the portfolio or borrowers missing payments. We're reserving at 0.89% per annum on that portfolio. Okay, so you can work out what the inflow of money is into those reserve funds based on the active book. our modelling suggests that the credit risk, or the expected credit risk in our portfolio, is 0.46%. That credit risk assumes tail risk, okay? So we're planning for tail risk. We've assumed house prices decline 30% from settlement value when we go into this and look at what we expect those loans, what we expect the credit risk is in that portfolio. Okay, so that's our expected tail risk. Our life-to-date default rate, so this is the default rate that we've actually experienced, is 0.05%. So that's 5 loans in every 10,000 that we write going bad. That's what we've experienced when you kind of work it through back to a percentage level. This is, and that's 3 loans. So life to date, we've had 3 loans default with a loss. You can also work out a credit risk ratio. So how much coverage does the reserve fund have based on the expected level of risk? So based on that 0.46% of risk, that ratio is 3.8%. Okay, so we've been pretty conservative in the way that we are reserving to make sure that we cover those expected credit risks should they eventuate. Here's our performance to date. So if I go through each of the 3 main lending portfolios, so home loans, we've been running for 5 years. We've written 168 loans. We've had no defaults. So there is no default rate that I can even report to you. For our construction loans, we've been running for 6 years. We've written 800 loans. We've had 3 default, which gives us an actual default rate in dollar terms of 0.05%. Okay, so that's our experienced loss rate to date on those construction loans. Remember, we're modelling or expecting credit risk of 0.46%. We're reserving at 0.89%, and our actual rate that we've seen is 0.05%. Personal loans, running for 9 years, we've written 3,500 loans. We've seen 123 loans default for an actual default rate of 1.14%. Some people might say, well, wow, that's a big jump up from the secured loans. Well, yes, and that's the nature of personal lending. There is a higher risk portfolio. And I think I showed you the Australian data earlier, which suggested that that was running at about 2.5% through that GFC period for Australia. So overall, that default rate at 1.14% actually is pretty good. And the quality of that portfolio today is even higher than that. And I'd expect that actual default rate to come down over time. Are there other risks to consider? So when we're thinking about credit risk, the sorts of things that we think about, and these are just purely examples and certainly not extensive, it's just some things that we might consider. So where's the location of the property that we're going to be secured against? The risk of being able to sell that property if it's in Gore might be different to if that property is in one of our metropolitan locations, for example. The number of buyers in Gore is likely to be less than the potential pool of buyers in a larger centre. Another example might be, is the property a luxury property? So is it the upper end of the price kind of bracket? If it is, that's going to make it a whole lot harder to sell. And we also see more volatility in prices, house prices, that is, for luxury property. So if we were writing a loan on luxury property, which we don't do very often, we're more likely to do that at a lower LVR to help manage that loss given default risk that we talked about earlier. We also look at how strong is the financial position of the borrower. So, a stronger borrower with a better net asset position and better income is likely to be a stronger risk than someone who doesn't have those things in their favour. We also then, in the case of construction projects, we'll try and understand all the various risks that go into construction. And, I could do a whole webinar on that for an hour, and we would have only scratched the surface around construction risk. That's everything from what are the geotechnical risks to what are the exit risks of being able to sell the property once they're built. All those sorts of things come into play. Alongside those credit risks, there are other types of risks of investing. So you've got macroeconomic risks. What happens, for example, if the unemployment rate in New Zealand goes from where it is today at somewhere over 5%, perhaps to 10%? We get a much more severe recession come through for some reason. Heaven forbid we get to Ireland post-GFC at 14.5%. So, there's risks there. Borrowers may, if they're relying on their income to pay their loan, that could be quite problematic. You have cybersecurity risk. There's liquidity risk or withdrawal risk, as I've noted it on the slide here. That is the risk related to how quickly you can get your money back in the event that you need it. Okay, and so that's not today's discussion, but liquidity or withdrawal risk is something to consider. How quickly can I get my money back? You also have interest rate risk, so the chance that interest rates will vary up and down. We're in a falling interest rate cycle, and we've got a rate change taking effect at the moment. So, interest rates are lower. So you've got some interest rate risk there. You've also got concentration risk. So are you, if this is your life savings that you're investing across, maybe a handful of different players in the market, are they all invested in one thing? So let's say you've invested some money with Squirrel, you might have invested some money with First Mortgage Trust. If it's all residential property or commercial property or industrial property and debt related to those that you've invested in, actually your concentration risk is quite high. Despite the fact that it might be relatively safe type of lending or lower risk type lending, actually concentration risk is still high. So if you read most books, diversification is important. So concentration risk is something to keep an eye on. That gives you an overview of some of the other credit type risks that we consider and some of the wider investing risks that we have. So as a summary for part 2, remember this was about how Squirrel helps manage that credit risk on behalf of our investors. We have 3 layers of credit risk protection in place. So layer 1 was we're going to assess the borrower and make sure that they're worthy of the loan that we're going to provide them. No different to the way that a bank operates. Second thing we're going to do is we're going to take security by way of typically a first mortgage for most of the lending that we do. And we're going to lend at an LVR, loan to value ratio, that's appropriate to the situation of the borrower. So typically higher risk will mean a lower loan to value ratio that we lend at. And then that third layer is with Squirrel, you've got that unique protection that we offer of the reserve funds. Okay, so those are those 3 core things that we do to help try and manage that credit risk for you, help protect your capital and deliver a regular, reliable return. The reserve funds, how do they get money into them? So part of each borrower's loan repayment is diverted to the reserve fund. So that's how the reserve funds get money and help manage that credit risk for our investors. You get the diversification benefits of when you invest with us of the whole portfolio via those reserve funds. Okay, so you're not investing into individual loans. You get the benefit of that whole pool of loans and what they do, which is a really positive thing. If I go back to that GFC period, some of the finance companies that fell over through that period, they might have lent 30 million on 3 different property developments by way of an example. If any one of those 3 fell over, the whole thing collapsed. At Squirrel, we have lots of active loans. So in our construction loan portfolio, for example, we've got about 220 active loans. Lots of smaller ones, that creates diversification. We have a huge amount of information on our website, transparently describing to you the type of credit risk that we're taking and how we're managing that and how the reserve fund's performing. So if you head to the Save and Invest menu on our website, look for the View Performance page, you'll find some of the information that I've described to you here today. Last but not least, we plan for tail risk. So hopefully we've demonstrated that with some of the data that I've shown you in the second part of the presentation about how we manage those risks, expecting that things are going to go bad one day, because inevitably they do. So that's the risk we really worry about and try to manage too.